Understanding how raw market data transforms into portfolio analytics is crucial for reliable risk management. In this video, you'll learn the four-stage process that converts portfolio selections into clean price data, calculated returns, and correlation matrices ready for Monte Carlo simulation. Data processing begins when you select a portfolio. The system automatically uses Excel's stock history function in the Fetcher worksheet to retrieve historical prices. Your date range from cells B30 to B31 controls which data gets fetched. Stock history has important limitations. It typically provides 1 to 2 years of historical data maximum. International markets may have data gaps. Internet connection speed affects performance, and some assets may return unavailable data errors. These limitations require systematic handling in the next stages. Raw stock history data moves to the prices worksheet for initial cleaning. The system removes duplicate dates, sorts data chronologically, and identifies missing price gaps. Weekend and holiday gaps are normal and expected. Price data quality varies significantly. Some assets have clean, complete histories. Others contain price spikes from data errors. Missing values marked as errors or zero prices from trading halts. The system flags these issues for automated correction in the next stage. Error cleanup is controlled by cell B130 in your parameters. When set to true, the system automatically handles data problems. When false, no cleanup occurs, useful for validating raw data quality. The system detects several error types, price spikes exceeding 50% daily changes, missing values, zero or negative prices, and non-business day anomalies. Correction methods include forward fill using the last valid price, linear interpolation for missing values, and outlier smoothing for extreme price movements. Clean price data transforms into daily returns using standard financial formulas. Simple returns calculate as today's price divided by yesterday's price minus 1. Log returns use the natural logarithm of the price ratio preferred for statistical analysis. The final processing stage calculates asset correlations using Pearson correlation coefficients. The portfolio's correlation matrix is calculated in Corel's worksheet. This measures how assets move together, crucial for portfolio diversification analysis. System validation ensures data quality before analysis. Data completeness checks verify sufficient price histories exist. Statistical validation confirms return distributions are reasonable. The correlation matrix undergoes positive definiteness testing to ensure mathematical stability. Error counts appear in cells B34 and B35, showing how many data corrections occurred. High error counts may indicate data quality problems requiring investigation or alternative data sources.
Common data flow problems have systematic solutions. Stock history timeouts usually resolve by reducing date ranges or retrying during off-peak hours. Excessive hashtag in/A errors may indicate assets with limited data availability. Consider alternative tickers. Zero correlation warnings suggest assets with identical price movements. Check for duplicate tickers. Incomplete data ranges occur when date boundaries exceed available history. The system reports these issues clearly for immediate attention. Process data integrates seamlessly with portfolio analysis modules. Clean returns feed Monte Carlo simulations for scenario generation. Correlation matrices enable realistic portfolio risk calculations, accounting for asset relationships. The process then transforms raw prices data from Fetcher worksheet and cleans it into prices worksheet. Out of prices, returns worksheet calculates yields or returns based on perms. B16, the yield calculation type. Statistical properties support risk metric calculations like value at risk and expected shortfall. The entire analysis framework depends on this systematic data preparation process for reliable, accurate results. You now understand EasyRisk's systematic approach to data processing. From portfolio selection through stock history data fetching, error cleanup, returns calculation, and correlation analysis. Each stage builds toward reliable portfolio risk assessment. Quality data processing is the foundation of trustworthy risk management. Monitor error counts, validate results, and maintain awareness of data limitations for optimal analytical outcomes.